All right, cool. Just started recording. And let me know if you see this. Sweet. Well, hey guys, well, welcome to the let's go full screen mode. There we go. All right, sweet. Welcome to the VA Loan Crash Course. I'm Will Roberts. I'm the partner in military lending at UMortgage. That's my face. So some things that you're going to learn today are, principles of real estate or location, location, location. I can already tell you that you're making better choices than I did. I was in LA a couple weeks ago. I was visiting my buddy who lives there now, a friend of mine from the Marine Corps. This is the view out of his apartment. You know, this is the view that I had in Philadelphia. I think I know which one I would choose for grad school. Maybe if I had to do it over again. Um, feel like left a little bit to be desired in the views. So start from the bottom.
Did you, sorry to interrupt, did you cycle?
I did. Can you not see it?
No, it's for me personally, it's still on the QR code.
All right. Thank you. That's good to know. What about now?
It's moving now. I saw a tree with tires. Now I see a beach view.
All right. All right, cool. So that's my face. What I say is this is my buddy's view out of his apartment. Um, and this is my view in Philadelphia. I know which one I would rather have if I was gonna choose grad school again. So start from the bottom. Now we're here. I'm originally from Louisiana, bottom of the country. Went to the Naval Academy Prep School, Naval Academy, served in the Marine Corps as an open source intelligence officer for just under 6 years. Got out and started a direct-to-consumer art company called Paint True with a couple other Marines. Realized I didn't know anything about the business world and really wanted to learn more. So I put my name in the hat to go to Wharton. At Wharton, I wanted to be an investment banker. Went to Allen and Company in New York City. Got to do some great stuff there. Again, kind of realized I didn't know anything about the business world. Um, but then, when my second son was born, I was kind of looking for a little bit more in my life, a little more mission. And at that time, some friends, we had been talking for a while about starting a veteran-centric lending team. And so we founded the Veterans Alliance. And what is the Veterans Alliance? It's 17 veterans. We have people from all service academies, but all services as well. To a person, we're all obviously military veterans, but we all also got kind of screwed over using the VA loan, and we were convinced that there was a better way to do it than what we were seeing out in the market, and so we decided to found Veterans Alliance. And in 2023, we were the #1 VA lending team in the country. And so what this should really say is like, what's the difference between a broker, i.e. UMortgage, and a retail lender? So retail lenders are like Wells Fargo, Chase, Loan Depot, Veterans United, US Bank. They lend internal money and internal products. We, on the brokerage side, we handle wholesalers. So wholesalers are, transacting large blocks of loans, and, the rates kind of move a lot faster. There's instant pricing authority because they want to transact at the volume that they are. The other thing that's nice is because I'm not lending internal money, I get to do what's called a voiceover. So I'm allowed to speak on behalf of the veteran and say like what's going on. So if a veteran is graduating from, I'm going to pick my example. So graduating from business school and going into investment banking, well, 50% of their income is going to be deferred to a bonus. Normally, if I was lending internally, I could never have that conversation with the direct lendee. I could never tell them how to game the game, how to work on their credit, stuff like that. As a broker, I get to do that because I'm not lending internally. And I want people to win. I am not paid on rate. I'm not paid on loan size, anything like that. At the end of the day, I want to do the best job I can for vets. And that's really it. And then what they say about banks, the house always wins. It's just like gambling. That's that. So there's some truths about the VA loan. So I always hear this like, oh, the VA is lending me money. The VA is not lending you money. The VA is guaranteeing you 25% of the loan amount as insurance. So, on a traditional loan, you put between 5 and 30% as down payment. and then the bank lends on the rest of the amount of money. So somewhere between 95 and 70% of loan value. What the VA is doing is saying, hey, bank, you can lend 100% of the loan value, and we're going to guarantee you 25% in case that veteran becomes insolvent. And so for the bank, it's a great deal because they're lending 100% loan to value. It's a great deal for the veteran because they're not having to bring that cash down to the as a down payment in order to close. So it's a really win-win thing. Some other things, you can use VA loan more than once. You can have more than one active VA loan at a time. That's the only time that you hear something like a limit or a county loan limit is if you have multiple VA loans. So you could have, and I talk about no size limit, you could have one loan that's $4 million, or you could have county loan limit at LA is basically $1.1 million, or you could have 10 $110,000 houses in LA, as long as you meet the time requirements of like living in each one. So you can have more than one and you can use it more than once. You can also buy a condo, a fixer upper. The VA became very flexible in 2021 when veterans were losing out on housing. Because candidly, the VA has three missions: is provide medical care, training, and education for vets to get jobs, and help secure housing. And they were like utterly failing at the third, competing in an all cash market and very low interest rates when everyone wanted to transact. And so they changed a lot of these things. One of the things that you can do to make your offer more competitive is put a down payment or an earnest money. Technically, you can put 100% down on a loan, and at the closing table, you would receive that 100% down payment back as cash. It makes no difference to the lender or to the VA, but you would do that in order to show that you have skin in the game, right? Like I hear that all the time, like, oh, the buyer doesn't have skin in the game because they're using a VA loan. And I'm like, oh, that's interesting. Well, when he was in Iraq and you were hanging out in Miami, you didn't have any skin in the game then, but now when he wants to buy a house, it's a different story. So, just remember, you can always put down a down payment. You can do whatever you need to get the deal done. Many items can be waived. So you can waive inspections, finance contingencies, appraisal contingencies, all that stuff is waivable. The one thing that is not is an appraisal. And that's because that's a national law. If you have a mortgage, you have to have an appraisal. And that's so that 2008 doesn't happen again. I already talked about it, but there's no size limit on the VA loan. So you could, the largest loan that we've written is about $4.5 million. So you could have a $4.5 million VA loan. If you made it work, you could have four $1 million townhomes that were owned in a condominium and you rented all of them out. I'll talk about that more later, but just no size limit basically. And the biggest takeaway from this is the only home loan that is earned. Don't let someone who stinks at their job, whether it's another broker or a lender or a real estate agent or a seller or someone that isn't in your shoes and actually cares about you, tell you that you shouldn't use the loan. If they're telling you that you shouldn't use the loan, it's probably because they don't know what they're talking about, or they're being incentivized to tell you to not use it. Because the fact is even if you have $1 of entitlement remaining, right? So in that scenario where you had 10 homes in LA, each there were $110,000. If you had $1 remaining before you hit your county loan limit, you should still use your VA loan. Why? Because you get the protections of the VA as well as all the benefits of lower interest rates and everything that come along with the loan. So it's a great product. VA loan eligibility. So, most of us have done this, right? You need to serve on National Guard for 90 days, including 30 days of consecutive duty. And the first thing that I'm going to do when you call me is pull your certificate eligibility, which looks like this. So your certificate eligibility spells out basically what you're eligible for. So this is when I did Big Dog Chesty Puller's loan in Washington, D.C. So Big Dog wanted to buy a house at 8th and I, $4 million place, really nice. And he was charged $4 million, or sorry, he paid $4 million and he was charged $1 million of entitlement. So what that means is that the VA paid 25%, or rather guaranteed 25% in his entitlement. So let's just say that this was 10% of this, $400,000 and $100,000 of entitlement. You see down below that this says this veteran's basic entitlement is $0. So that basic entitlement is based on a $144,000 home. So every veteran in every state in every scenario has a $144,000 home that they can purchase. and they're allotted $36,000 from the VA of entitlement. Once you use more than that $36,000, that goes away. So even though in this case where I said that, it's 400,000, 100,000, which in DC it's the same loan limit as LA County, you'd potentially have 400 or $800,000 remaining in eligibility. In this case, your basic entitlement would still say zero. So this is where you don't let someone that stinks at your job tell you don't have any entitlement left. It's just that you don't have any basic entitlement. Everything past that $36,000, $144,000 purchase is secondary entitlement. The other reason that I pull your certificate of eligibility is to make sure that you don't have any corrections. I can't tell you how many times I've pulled this thing where it says that, you were in the Army when you were in the Marine Corps, or, that you were never on active duty, or that you have a house pre-existing, and like this stuff happens. It's a large bureaucratic organization. It's not a dig on the VA. Like sometimes that stuff just happens. But it takes 20 days roughly to correct it. So we want to get ahead of it as soon as we can. So when you're trying to close, we're not like backpedaling and trying to get stuff done. So I own a house with the VA. Can I buy another? So this is what I'm talking about. Like where let's say you purchased a $600,000 house in Virginia Beach, right? So you were charged $150,000 of entitlement. Can you guys see my mouse on here? All right, we'll just see.
No, I can't see it.
Okay.
But Will, I did have a question on the last slide.
Yeah, Jeannie. And if you have any questions, just please pop off and ask.
Just for the certificate of eligibility, I'm not planning to buy in the next year or two, but should I pull this already? Should I wait till I'm going to buy?
Yeah, that's a really good question. So the other thing that I pull is, so yes, you could, there's no too early point to pull it. The other reason you want to pull it is I just did this for an Army vet. So he deployed in September 2020 and ended a lease on his car. So I do a soft pull of your credit. So soft pull is not detrimental to your credit report. No one really knows that I went in there. And the other reason to do that is that you find out if you have anything detrimental in your credit and you get time to fix it. So in your case, Janine, you've got a year, right? Well, let's just say that there was something derogatory on your credit report, or that they never knew that you're on active duty or reserve status in the military. It's just good to get ahead of that so that if and when you do get to the point of wanting to buy a house, you're not scrambling trying to get everything done. So I think that there's really no too early time to do it. Just go ahead and find out, make sure it's good. And if it is good, then, call me in a year when you're ready to buy. But that's, it doesn't take anything to do those two things. So you buy a $600,000 house, you're charged $150,000 entitlement. So let's say we're doing in San Diego County, the best place in the world. So you take the county's loan limit, which is 1,149,825. 25% of that is $287,000. You take that $287,000 minus the entitlement that you were previously charged, and it gives you your remaining VA entitlement. Now that number times 4 is the max net price of the home that you can purchase with no down payment. And this is what I'm saying. If you have $1 remaining, you just pay 25% on the delta between what you're trying to buy and the max no down payment purchase. So in this case, let's say you want to buy a $1.5 million house, and I make these numbers big just to drive home points. You're buying a $1.5 million house, you have $550 in budget for no down payment, you bring to the table $237,000, which is pretty great. To put that in perspective, the average civilian who's purchased a home is paying around 25%, 20 to 25% down payment. Or they're paying a bunch of private mortgage insurance, PMI. So the other thing is that so funding fees. So when you get a VA loan, if you're on active duty or on reserve duty and you get a VA loan, you will pay a funding fee. If you are in service and you have a Purple Heart, you pay no funding fee. If you are a veteran and you have a service-connected disability, 10% or more, you don't pay a funding fee. Now, if you were able to serve for 90 days and didn't stub your toe, then that's better than me. But you just need 10% or more to not be eligible for the funding fee. And even if you aren't eligible for disability, 2.15% funding fee for your first time use or 3.3 for the second. Now you can do some down payments and reduce your funding fee, but this is where like the time value of money conversation comes in. Let's say you put 5% down on a $300,000 house. So you're putting $15,000 down. I don't think it's worth it to pay to put $15,000 down where you'd be earning $1,500 notionally in the stock market on that money per year to save you 0.9%. Okay, it doesn't make sense to me there. So I would either, most of the time I recommend to people to not use a down payment. And again, if you have service-connected disability or retroactive service-connected disability, so like if you got out of the Marine Corps or Navy on January 1, and then on January 2, you bought a house, and then on January 3, you were awarded VA disability backdated to January 1, which is most of the time how it goes, you would retroactively receive a funding fee refund. So the VA would send you a check for 2.15% of your home. Which is a nice birthday present. So qualifying. So there's 4 pillars of a mortgage.
Hello,
Credit.
can you hear me?
Yes.
Sorry, quick question about that, the funding fees. So if you're a disabled veteran, there's no funding fee for first or even subsequent use?
Correct. You'd
It's
never
just-
pay a funding fee.
Wow. Okay, that was exactly one of my questions. Thank you.
Yeah, tremendous benefit there. And same deal goes if you were like, here's a good example. So I helped a gunny who he received a TBI when he was on active duty. He had purchased a house when he was on active duty, and then later received a Purple Heart that was for his TBI that predated the purchase of his home. Well, because the Purple Heart predated the purchase of his home, he was able to have his funding fee. Now this was like 10 years in like, in the future, he was able to have his funding fee returned to him, which is pretty cool. So even if you're like working on your service-connected disability, or like working on getting your disability rating, you can still get it refunded. So 4 pillars of mortgage: credit, assets, income, employment, property valuation, and appraisal. Top 3 you can worry about. The bottom one, just let it happen, and we'll figure it out. Credit scores. I'm not going to bore you with what a credit score is. They range from 400 to 840. Basically, what you need is anything above 700, 720, you're going to get a really great rate. Like 740, you're going to get the best rate you possibly can. And this is where, Ginny, I'm talking about like a year out, you still have time where you can pull your like I could pull your soft credit now and you could see if there's anything derogatory, and then you could start working those things, whether it's pay down a balance of a loan, whatever. I mean, some people forget that they have, small payments. Like big ones, you're probably gonna get a call from someone, but like some like Spotify payment that was from 5 years ago that you don't know is on your credit, you'll find out it's there and you'll take it away and your credit will pump up. A soft pull does not affect your credit profile. So that's what I do, again, because I'm a broker. If I was a lender, so like when you go to an auto dealership, they do a hard pull. So hard pulls are like a lending specific thing. I only do a hard pull right before we close. And then if your closing lasts more than 120 days, which very rarely they do, but if they did last more than that, 4 months, then I would pull your credit again at the 120-day mark. And then my last plug on this is lots of us have credit cards, which will tell us our credit report or credit score rather. So they'll say, American Express will say, oh, you have a 720 credit score. Most of the time those are inaccurate, at least in my experience. I've found them to vary up to 100 points. The best way to pull your credit is from annualcreditreport.com. It's a government sponsored service. You get 3 of them a year, and you can pull your credit report for free. Now, it doesn't give you a score. A score is a lending thing. Like I can give you your score, but you can pull your credit for free and just make sure there's nothing derogatory. And you should do that, like besides any loan or anything like that, you should do that roughly every 4 months, going to annualcreditreport.com and doing it that way. Assets, so 401ks, IRAs, stocks, TSPs, basically any cash or cash equivalent, the van sitting in behind your house, those are all assets that can be used to buttress your loan. Any gift from a non-interested party. What's a non-interested party? It means that they don't have ownership or any plans to have ownership. So you can't sell part of your house for a gift and then like later have, that person be on the deed of the home. Like that won't work. That would be what would be called a due on sale clause, and the lender would make you pay off your loan instantly. And any gift does require a gift letter. So if your parents or friends or uncle wanted to give you $10,000 for graduating from USC, there would just need to be a letter that says like, hey, I'm really proud of Jarek, and here's $5,000 for him graduating, Semper Fidelis. And then Jarek would submit that. We would show that that was a gift. Any other cash needs to be seasoned, which means that it has to have 60 to 90 days of sitting in an account. Like you don't want $100,000 of Bitcoin money to show up on the day of closing. Like that's not going to be okay. But if you have 60 to 90 days and can show where the money came from, that's a big thing. This is lasting. This is everlasting for like the days of like cash, when people would just like, sell cars or buy cars and houses and stuff with cash. That seasoning needs to occur. And if, let's say you did get a student loan refund, if you did have some amount of money show up in an account, that's fine. You would just need to document it. And you may use a loan for closing costs. So closing costs are roughly 1 to 3% of the purchase price of the home. So $500,000 house, you're paying, let's say 3%. You could take a loan for 15%, but the cost of that loan, your monthly payment, let's say it was a 2-year loan, that $700 and so would be counted towards your debt to income ratio. Income and employment, that's why you came to school. So you traditionally need 2 years, or what we've been able to do specifically for veterans is to say that basically you went from active duty reserve time to an education institution in order to receive training and education to go get a job. And then now you're graduating. If you have a full-time offer letter, then you can close on a home. You can close out 60 days from when you started your job. So if your job starts July 1st, 2024, you can close on May 1st, 2024. And that 60 is really kind of like a soft number. We've even been able to push to like 90 days, but it depends very specifically on your file and what your asset portfolio looks like. For one vet, we were able to do 120 days, but he had a lot of savings and was able to show that he had the reserves in order to make those payments until he started his job. Self-employment requires 2 years of tax returns. This also comes into effect if for people that are doing what's called like a search fund or starting their own business. Organize your search fund or your business in a way that that business is an LLC and is giving you a full-time offer letter to manage that business. And then more than likely, we can use that in order to qualify for income. Any non-taxed income, so BAH, BAS for active duty folks, disability for veterans, is grossed up 25%. So if you make $1,000 a month in VA disability, it actually counts for $1,250 towards your debt to income ratio. And then let's say that example where you purchased a house when you're on active duty and now it's a rental, you need 2 years of tax returns and 3 months of PITIA. What the hell is PITIA? It's principal, interest, taxes, insurance, and association fees. And that association fees is big because let's say it's a condo in Chicago when your last duty station was Great Lakes, and that condo fee is $1,500 a month, which is an actual real example. You have to have $4,500 in addition to 3 months of your principal, interest, taxes, insurance payment, your mortgage payment, ready to go in order to have that count towards your income level. The other thing is that if you don't have 2 years of tax returns, it's not a big deal. We would just take 75% of your gross rents, and that's what we would count towards your income. Property values and appraisal. So I told you that VA loans had a terrible stigma of, mandatory inspections and no chipping paint and, oh, you can't have any termite damage and all this stuff. It's just not the case anymore. The VA has been very clear that like they don't want veterans losing out on homes for stuff that's avoidable. The biggest thing is that some states do have mandatory termite inspections. But like I live in Connecticut, which is up in this Northeast region. which is a termite state. But I didn't have to do a termite inspection. Why? Because the house that I bought had an active termite plan in place and had for like 50 years. And the owner could show that. The other thing was that I had a termite inspection done on when I did my like regular purchase inspection. So the person that did the inspection said, "Hey, I don't notice any termite inspection." I didn't require a secondary one, which was really good. Um, Many things can be waivered. It's just like the military. You can get waivers and exemptions for everything. The VA is the same place. The only thing that can't is an appraisal. But let's say the appraisal came in low. So you're buying $1 million house, appraisal comes in at 950,000. The buyer pays $50,000 to close. The other option there is, again, let's say it's 1 million and comes in at 950, is you can rebut the appraiser to the VA and say, like, I don't think that that person hit the right number, and here's why I think that. And so like you and your agent could submit a letter to the VA and say like, yeah, I think he or she should have used these houses and it would have netted this value. Um, and right now the VA is more than likely going to side with the veteran, which is pretty great. Underwriting. So the underwriting process is what, someone that is supposed to be unbiased. So like unbiased, right? Like I am a veteran. I presumably am working for you guys. I would be biased in writing the loan. An underwriter is an unbiased source that looks at your file, and I get to say, like, on your behalf, what you're bringing to the table. But the one thing that they can't look beyond is residual income. Now, there's a way to calculate residual income, but it comes into your specific case of where you are in the country and all this stuff. What you want to remember is that basically the VA breaks it into 4 parts: South, Midwest, Northeast, and West, going from lowest to highest. So the West Coast, best coast is also the most expensive. But the other thing that's very interesting here is I'm from Louisiana, very much the South. I had no idea that Delaware was the South until I still started working with the VA. So that's just some interesting, I think, government map work there. Um, and the other thing about residual income is this is one of the only hard stops. Basically, everything past this, like I can talk through, like I can, work with you on stuff like that, but I can't get an underwriter to look past if you don't have enough residual income. And basically what you remember here is like you need about $1,400 roughly, plus a little like maintenance allocation for a family of 4 in the West. So just don't try to like stretch it very, very thin there, but that's something we would work on and figure out together. So debt to income calculation. So I say stuff like front end and back end. So front end is just your principal and interest. It's what you use to figure out what you want to spend or what you want to your purchase budget should be. And then back end is everything in your life. So it's more principal, interest, taxes, insurance, recurring bills, debts, loans, childcare, stuff like that. So the numbers that you should aim to be below front end, you should not go above 50% debt to income. So if you're making $5,000 a month, you should not have a mortgage payment that's greater than your principal and interest payment that's greater than $2,500 a month. And then back end, you should aim to be about 70%. So similarly, back to that, you're making $5,000 a month. Your all-in stuff should be about 3,500, netting you about $1,500. So going back to that, you know, um, uh, residual income piece. So the other thing is that that manual underwriting. So the ability for me to come in on your behalf and say like, well, this person is going to be a consultant and is going to make, $50,000 base and then another $50,000 of bonus is a savior because I get to talk about compensating factors such as a job or, if you're pending a disability or anything like that. Student loans. So lots of us have student loans. I had student loans. You take your balance of your student loans divided by 12, and then it's 5% of that per month. So, which is pretty fair considering the student loans right now are like 8% interest rate. Loans and leases with less than 10 months can be excluded. So unless they're significant, and I put things in quotes when like I think they're like lawyer speak. I don't know what's significant. Like, there's no definition of significant, but I would say it's like if you purchased a Ferrari when you're on deployment and your payments I don't know, $3,000 a month, it's probably significant. We're going to have to count it. If it's a Peloton and you have 10 months left at $65, not significant. Spousal debt is determined by the community property laws of that state. So sometimes I will recommend to clients and borrowers, hey, we should take your spouse off of the loan. And people get really weird about that, or, kind of freaked out because they're like, wait, I want my husband, wife, partner, whatever, to be on the deed. The deed and the loan are two different things in a non-community property state. So in Virginia, for instance, if you wanted to get a loan purely in your name and then have the deed of the home in two people's names, as long as they're married, that's completely fine. They're two separate things. And why would we do that? Let's say that you had a bunch of student loans because you went to, USC and you're graduating, but your spouse does not. Your spouse could, and they're a veteran. The spouse could qualify for the loan, and then you could just be sitting off to the sidelines holding all this debt, and they could look very unencumbered on their debt profile, which would help the file complete. Childcare could count towards residual. It always counts. Sorry, it always counts towards residual. It could count towards DTI. So how does it count towards DTI? If you have a recurring bill, so if you're paying for a loan to send your kid to private school, that counts towards DTI. If, they still have payments coming for childcare, that's DTI. It always does count towards your residual, though. The VA assigns an amount of money that it costs for your child. Commuting costs. So this one's like one of my favorite. What do you think the max distance that you have to drive in a car per month before I have to be like, hey, I don't know if I actually believe that you're making that, or not that I don't believe it. I think you might need to explain why you're driving so far. What do you think the distance is per month?
3,000?
Derek, that's the closest answer I've ever gotten. It's 4,500. So if you're driving 54,000 miles a year, then and only then would I have to be like, hey, I don't necessarily think that you living in San Francisco and working in Houston, Texas are going to work. But then this is where you could be like, well, hey, actually, I only have to be in Houston once a month or once a quarter or even once a week. And there's a direct flight that I take, which makes it really easy. And so we would just put that in writing and the underwriter would go through it. So this is what a debt to income calculator looks like. So this is made on Excel. You put in your base income, your disability level, which gets popped up 25%. And then this gives you your front end DTI. So you can start to look at, well, what does it feel like if I make a $7,500 payment and I'm making $15,000 a year, or sorry, a month at different interest rates. And this gives you your bracket of what you should look at when you're looking at Zillow. Multiple buyer scenarios. So 2 non-married veterans. So you have a boyfriend, girlfriend that you want to purchase a home together. He or she is a veteran as well. Each veteran is charged 50% of the entitlement, but unfortunately you can't stack the eligibility. So if one of you had previously purchased a home, remember it goes back to that entitlement calculator. You can't stack both of them on top and now buy and now have in that previous example, let's call it $500,000 entitlement. It doesn't work like that. You just get 50% of your remaining. A non-married co-borrower. So again, you want to add someone to your loan to, your parents, your brother, your sister, your partner, fiance, significant other. One is a veteran who's eligible for the VA loan, and one is a non-VA eligible borrower. The VA only provides 50% of that 25% guarantee, so 12.5%. And then the non-veteran co-borrower brings 12.5%. The one stipulation here is that both people have to support 50% of the loan amount. So what this really means is the veteran has to support 50% of the loan, and whoever their co-borrower is can't be floating the whole debt. So property types, the predominant VA loan is a single family property that is supposed to be a primary residence. So the rule on this is that it's supposed to be a primary residence at the time of purchase, occupied within 60 days, and shall be occupied for 1 year unless a valid change of circumstances happens. So what's a valid change of circumstance? Your job changes, you PCS, you lose your job, you need a bigger house because you now, have a child. Stuff like that's all valid. What is not a valid circumstance? You wanted to house hack when you're on active duty, and so you bought one place in Virginia Beach for $150,000, and then a month later said, I don't feel safe in this neighborhood, and then you went and bought another $150,000 house, and then a month later did it again. And then a month after that, you're like, I'm going to use this FHA loan because I've used up all my VA entitlement. I'm going to buy the FHA loan. And so you now have 4 houses that you've kind of scammed your way into. And oh, by the way, you get a call when you're on the deck of a ship saying, hey, you have $600,000 in houses with 4 different loans, and we want that money in 2 days. And then you're freaking out because you lied about a valid change of circumstance. That's an actual example that actually happened to someone that I know. So don't cheat the system. But if you do have a valid change of circumstances, that's totally right. That happened to me when I graduated from Wharton. I bought way more house than I should have, to be totally candid. And I kind of freaked out 8 months in because I didn't want to do that job anymore. And I wrote the VA a letter or an email, and I said, hey, I don't want to do this job anymore. My wife's leaving active duty. I want to move to a much more reasonable house. And they were like, you're good. Your entitlement is, or we actually used my wife's entitlement for the second one, but like, you guys can go buy another house with VA loan. Remote work just needs an employer statement defining in-office versus work from home. So remember that example I said where, you're commuting from San Francisco to Houston? It would just need to say like, hey, although our office is in Houston and Timmy's going to be in San Francisco, they receive the same amount of benefit from being in San Francisco that they would in Houston, and they only need to come to the office once a month, and that would be fine. Commuting, I told you, 4,500 miles per month. And then this is a really interesting one. On January 1, the VA made it allowable to purchase a single accessory commercial space attached to a residential property. So what does that look like? In places like Arlington, Virginia, Alexandria, Virginia, Charleston, South Carolina, Brooklyn, basically dense city centers that are older. And so, you would have like a bodega or like some type of restaurant in the bottom of it with a residential property above. You can buy that entire building with a VA home loan. So you can buy basically a commercial building with a VA home loan. And that's huge because commercial properties traditionally need like 30% down and the interest rates are way higher. But in this example, you can purchase, like there's one that I looked at in South Carolina. It was a Subway in Charleston on King Street. And the building was like, I want to say it was like $1.5 million. And the Subway triple net leased for $45,000 a year. So the Subway was paying the owner of the building $45,000 a year, and you could live above that and have over half of your mortgage paid for by Subway. So that's a pretty cool thing. Another way to get stuff paid for that you own is a multifamily property. So you're allowed to have up to 4 family residential property. Anything over 4 family is commercial. So you can have between 1 and 4 units as a residential property, and you must occupy just one of the units as your residence, and you need to prove the likelihood of success as a landlord. What does that mean? Is it like being a corpsman in the Navy and working with Fleet Marine Corps? Probably, like maybe, but you just have to say basically why you believe you're going to be likely to succeed as a landlord. Most of the time, the VA is going to say yes. I, in fact, have not seen them say no. And you need to have 6 months of mortgage payments in reserve. So, if let's say, so I give an example here. Let's say these are big numbers, but prove a point. Let's say you purchase a $1 million place, your mortgage payment's $8,000, and you want to buy now 4 of them. You have to have 6 months of $32,000 payments. So you need to have, what's that, $194,000 in cash in order to qualify for this. So it does get pretty big, pretty fast. But if you have that cash, you can do incredible things with it because you're able to count 75% of your rental income towards your effective income, which lowers your debt to income ratio. And then if you do not have experience managing a rental, so this is your first time purchasing a rental property, managing tenants, stuff like that, you have to have a property manager in place on the date of closing. If on the next day you fire that person, I guess you're going to figure out how to be a landlord. This is what the same GTI calculator I just showed. This is just showing you the power of purchasing a multifamily. So basically, if you're approved for, let's say, a $1 million single family, you're 3.3 times that roughly with the multifamily side. So it's an incredible buying opportunity if that makes sense for you. Put differently, let's say you find one that you really like that's $1 million, and then you buy a second one, and then it's in a townhome complex, so let's say Arlington, Virginia. Now, one big disclaimer, this takes a rental market that can support a high rent to payment ratio. So in this case, your payment's $8,000 and your rent is $8,000. Where does that exist? Like Dallas, Texas, Austin, Texas, Nashville, Raleigh, North Carolina. I've seen it in Miami, in the New York area where I live right now, in LA, San Diego. Like stuff can work like this where people have a higher willingness to pay and they're willing to pay more rent for a nice place. You can make this work. And so like, let's say you find one and it's $1 million. So you look at your back end DTI and it's 35%. Cool. Will said, I'm good there. Look at this 55%. Cool. I'm good there. Look at 3. Cool. I'm at 69. And then you're like, oh, wait, that's right. Will said I couldn't go over 70% back end DTI. It blew up. My DTI blew up. That's actually wrong because in this case, in reality, your DTI is 35% because we only get to count 75% towards your eligible income, but in reality, your rent is a whole lot more. So this is where that manual underwriting comes in, and we get to say, well, actually, your DTI is like 35%. So they would be good here. So my purchase example, this is what I would tell you not to do, right? So like I graduated from Wharton. I had a big investment banking salary in New York City. And I was like, I want to get the biggest house I can with a steam shower. I'm really ready to enjoy my life. So I bought a house in Greenwich, Connecticut. It was $2.725 million. And luckily it worked out. At the time that I made this deck about a month ago, that home had increased about $500,000 in value. So I made a 10.6 annualized return on that. And my principal, interest, taxes, insurance, and association fee were just under $15,000, and it rents for $17,000 a month. I talk about like willingness to pay. When I look for a rental property, or really any property for that matter, I look for a 10 out of 10 school zone, and specifically, I look for a Whole Foods because my mindset is that if you're willing to pay $8 for an avocado, you're probably going to be willing to pay a higher, rent fee and also be willing for that rent to increase throughout the time of your lease. That's called willingness to pay. And on the 10 out of 10 school district, that's kind of hedging my bet. I am very bearish and extremely conservative when it comes to how I spend not only my own money, but especially others. And so if I believe that the markets are overinflated and about to crash, right, I'm bearish, then what do I think is going to be the magnetizing force for home values? I think it's 10 out of 10 school zones. Why? Because let's say someone had a $2.7 million house outside of a 10 out of 10 school zone and is sending their kids to private school. So here in Connecticut, it's like 40 grand to send your kid to private school. So they're sending them to private school and then their income drops in half. Are they going to continue sending their kids to private school at the expense of like taking on debt or something? I'm going to say no. I think they're going to soak in value into their home, place value in a home that's in 10 out of 10 school district, and send their kids to public school. That's my bet. Lots of people have other ideas about real estate investing. I have a friend that looks at, he draws concentric circles around Trader Joe's, Whole Foods, Core Power, Bonobos, and Starbucks, and then finds like the neighborhoods that intersect there, and that's where he goes to buy. So my 4-year ROI from rental, my return on investment, is 50% over sunk costs. So if I go to, sell it when I leave after a 4-year hold, I'll make $450,000 on this piece of property. That's way more than I made as an investment banker, and a whole lot more fun than sitting in a dark room and working on Excel all the time. Now, obviously, these are insane numbers. I look back on this and I'm like, why did I do this? But it does, the nice thing is like this can happen in multiple different pricing scenarios in many parts of the country. So now I'd like to do a case study. So if you can go to the survey and just fill out basically like where you're thinking about buying, what you're thinking about buying, what your salary looks like, stuff like that. We'll build out a kind of like model person, and then we'll go and I'll show you exactly how I would go about finding a house that I would be interested in purchasing as someone who, I'm not saying that I have it all figured out, but I do, by just virtue of this job, get a ton of people that want to see or look at a lot of different stuff. So I'll leave it to that, and I'll put this link in the chat. Also here, there are Q&As. Which, Mitch, I just saw your question. Yeah, that's a really great point, Mitch. Yeah, so like right now, interest rates are higher than they were 2 years ago. And I like that you called it an upfront loss, because the cost to refi a VA loan is really, really, it's not cheap. I hate using that word, but it is cheap in comparison to a regular single family or like multi-family home. Basically, with the VA loan, you're just paying the title fees for the state, which is huge. But here, I'm going to put the link in, and so if you guys could go and fill that out, we will do a little case study. And if anyone has any questions, feel free to come off mute and ask them.
Hey, Will, I'm on my phone. Should I just plug in that link on my computer and I can do the case study?
Yeah, that'd be great. It's basically just to put in responses, just so that we can kind of build it out. I mean, there's just 4 of us here, or 5, including me. So like here, I'm gonna fill it out too myself.
Okay, I got it. I'm good.
Yeah.
I just filled it out also.
Cool. Thanks, Jenny.
Same.
While we're waiting, this was really helpful. Like I think I probably knew nothing about the VA home loan, so this was super helpful.
I'm glad you. And Jenny, I wouldn't be like down on yourself that you didn't know this stuff. I do this. So, lots of people are VA loan experts, right? Like, so it's 17 of us on Veterans Alliance. All we do is VA loans, and like we still find new stuff out. So, like the VA loan is incredibly dynamic, and you can do some really cool stuff with it. And like, obviously, I've thrown a ton at you guys today. But like you'll have the PDF, you'll have my phone number, of course. But like it's just good to start thinking about it, right? It's like going through any type of degree program. Like you learn a ton and you're like, oh my God, I don't remember how to do any of that. And then like you're gonna be looking at something, it's gonna spark some memory, and you're gonna go back to the PDF or call me or whatever. And you can do what Mitch did and buy a 3-family property. And like that's huge. Like, Jarek and I actually talked about this one of the first time we spoke. Like, I didn't grow up wealthy. I always wanted to be rich my entire life. And like now I'm building something for my kids, like that rental property, right? Like that's an insane, like this one in Greenwich, like in 30 years, that loan will be paid off, and my kids will have, let's say just in present day dollars, a $3 million property that's earning them income And if they want to go be like, I don't know, part of the Red Cross, like my wife did, like they can go do that. And not have to worry about like how to fit their bills and all this stuff. So I think that I just see the VA loan as this incredible opportunity for people. It's and obviously for vets. So let's see what we've got working.
I think
on-
somebody else has a question also.
Yeah, Justin, what's your
I got-
question?
I got a quick question, Will, about VA loan assumptions. Can you like I've read about those, and say you have a VA loan of, I don't know, there's a $500,000 VA loan, and the house is now worth 600,000.
Yeah.
You want to assume the $500,000. Can you get a second loan with today's rates to cover that
Yeah.
that other $100,000?
Yeah, that's a really good question. I'm gonna break it into two pieces. So first, I'm going to say yes, you can get it would be called a second tier lien. So you can get a secondary lien on the property for that $100,000, whether it's through a HELOC or something like that. So yeah, that's totally fine, and you would just pay the principal off the mortgage payment on the first loan, and you pay your second one, and those two would combine to give you your what we call your combined loan to value.
Okay.
And then your combined debt to income ratio.
Got it.
Secondary to that, I don't ever let someone assume your VA loan. Like if you find someone that's willing to sell you their VA loan, that's one thing. I'm not their broker and they're not a client of mine, but don't ever let someone assume your VA loan because it is always tied to your certificate eligibility. And so if that person becomes insolvent and that home is foreclosed on, you may not be eligible for another VA loan ever.
That sucks.
Yeah. So just like be really careful with that. And I know right now it's a super hot subject because 3 years ago people had rates that were, we call GPA rates. So, for me and you, Justin, they'd be like 2.2%. But now we're up at like, high fives, low sixes. People are really attracted to those low twos, low threes rates. Don't let yourself do something that could affect you down the road, and unless they're willing to pay an incredible amount of money for it, like incredible. So I'll answer. I have two other questions in this. So I guess Justin asked the one about equity. And there's actually one more about VA loan assumptions. So options for it. So you would have to find a house that has a VA loan and then negotiate assuming that loan. There are other loan products that are assumable as well. So, when you find a house, you could always ask, like in the initial, like, do what it takes to get if it's a competitive market, do what it takes to win the house, right? Like get the house and then figure it out on the backside. So like don't throw a bunch of stuff in the beginning of like, hey, I want to assume your loan if it's less than 3%, and I also might want to use this VA loan and all this stuff. Just submit a very clean offer, right? Like as clean as it can be. Like, hey, I want to do a conventional VA loan, and I want to do a pre-purchase home inspection. Cool. Seller's probably going to be all right with that. And then once you're in contract, then say like, well, hey, like what kind of loan do you have? Oh, cool. You have an assumable, I don't know, 3% FHA loan or USDA loan that I can assume. Yeah, I'll take that because interest rates right now are at 6%. Like perfect. But don't like add a bunch of cloudiness to the beginning types of deal. Okay. So just going to pull up an Excel sheet and show you guys. All right, let me know if you can see this. So basically, let's see what we shook out with the survey. So it seems that most people are interested in. I have one for Huntington Beach, one for Austin, one for Tampa, and then one undecided. So let's go with, let's see where we go. Oh, I've never had this out. I haven't even, this is probably by virtue of us having a smaller group. So I've got people interested. I have two interested in multifamilies, one in single fam and one in undecided. Does the person that put undecided want to put out a swing vote and say which one they want to do?
Oh, maybe it was me. So single family.
Okay, we'll do a single family. And then looks like most of us make between the predominant here is between 100 to 125. So we're gonna do 112, 500 on the yearly. It's like most of us have some disability between 2,000 and 4,000, so we'll just call this 3,000. And most of us are married and our spouse is making between 75 to 100. So we're gonna call this 82.5. And no spousal BAH or VA disability. It looks like we're thinking about a budget between 500 to 750,000. Okay, so this is the first thing you should do. So you put in your like you put in how much you're making and how much your spouse is making, your VA disability, and this gives you your gross income. Then you come down here. I didn't ask about this in the survey, but do we have student loans? Should I show you how to factor those in? Let's say
I mean, I don't have any student loans, but I know my spouse does. So yeah.
okay. Yeah, let's factor that in. Let's say that they have $25,000 in student loans. Do we have a car payment? Let's say we do. Let's say we have a $450 car payment, especially if we're going to a big city center. And we have a Peloton because we are millennials. And so it gives you this net income number right here. So then that comes up here, and this starts to give you your principal and interest payment. So you start to figure out like what you feel comfortable paying. And interest rates right now are kind of around here-ish. But what's good here is like you can get to say, well, like, okay, I'm making $112,000 and my spouse is making 82 and I've got some VA disability. Like, where do I want to shake out on this principal and interest scale? So this is not your payment. This is just that front end DTI. This is just your principal and your interest on the loan. And you start to say like, I think I would be like pretty okay with paying like $7,000 a month or less. And like, where does that net me on a budget? And so you look and you're like, okay, cool. Like my budget could, if I wanted to spend that, be between like 895 and 1.15 million. Sweet. Well, that matches what I wanted to spend, which like most of us wanted to spend between 500 and 750. So if we wanted to spend between 5 and 750, and in this chart, it's showing us like comfortability wise, like we'd probably be in this range right here of like 900 to call it 125. Well, cool. Well, let's see what we can find in this range. So do we want to stick with the range we originally thought, or do we want to go to the secondary range, or do we want to meet in the middle? You guys tell me.
In the middle.
Yeah. the
Okay,
middle.
cool. We'll go 750 to a million. And we're looking in San Diego. So then we're gonna pop up. Can you guys see Zillow?
Yes.
Okay,
Yes.
sweet. So let's go 750 to a million. And we wanted, most of us said single family. And we want like an actual house, not just like a shack, which you can definitely find. And let's do, what did I say? Let's do San Diego, my favorite place in the world. 'Cause we've got kind of a split vote. but we can maybe do a couple of them. So remember, I told you that I look for school districts. So I personally really like Zillow because you can go here and you can say exactly what you want out of a school district. So I want an 8 out of 10 school. And then I start to look and see like, well, where can I get that for my price range? This is like a great part of San Diego. Like I absolutely love this area, but I also really like North County. So like, let's look up here. You can see San Diego, a little expensive, tough to find. But like here in Oceanside, like this is a great spot. That looks nice. So you find a house that you like. I don't know. That's not going to do it. Where's that one with the free trees? This looks great. So you find this place, you're like, man, this could be great. I really like this couch. I'm gonna do some paint to this. This is gonna be an awesome house. You're like, all right, this is the one. $995, so we'll call it $1 million. So some things you want to look at. You want to read here, make sure there's nothing weird going on here. Check to make sure there's no HOA, stuff like that. The other thing, come down here, hit show more. Come down to this HOA and other financial part, and just make sure there's nothing like in a community assessment fee or like a community improvement fee or anything like that. You don't really see it on older homes, but on like a new build subdivision, there could be even something called like a builder's fee, and it could be like 5%. And so at closing, they could hit you with, in this case, a $50,000 bill because they're like, oh, that's the construction or like the community assessment fee. Just make sure nothing that is in there. And then come down here and check out what your property taxes are. So Zillow is pretty good about this, but in certain states, California is one of them, it goes on what the home transacted for. So California is about 1%, but it goes on the purchase price of the home. So if you bought this for $1 million, your tax assessment would be $1 million. So we're just going to assume 1% here. So then you take that back to the calculator and you say, okay, I found that house. It was $995. And, interest rates right now are about 6.25. My yearly taxes, remember I said about 1%. And insurance, that's a little high, but like this is where this is where you're like, you've picked a house, you're starting to get quotes. You're like getting to the point that you really know it. And let's say that quote comes in at $5,000 a year. And then no HOA, we already saw that. And so you see that your back-end DTI is 38% and your monthly payment, including everything, is 73.72. And so you're like, yeah, I feel comfortable making that payment because I'm making, collectively, me and my spouse are making $19,367 after all of our debts. And you're like, okay, cool. And then so like this upper rate limit is, let's say, so I'll say stuff like, hey, I think you should float, or I think you should lock the rate. So if I tell you to float the rate, that means that I believe that we're in an interest rate falling environment. And if I tell you to lock, that means I think we're in an interest rate rising environment. So let's say that like I tell you to lock or even vice versa. I tell you to float and interest rates actually go up, right? And you're like, dang it. Like the analyst was wrong, because our analysts are right like 55% of the time, which makes them experts, but they're not always right. So like, let's say interest rates go up and you're like, well, what does the interest rate have to go to for my back end DTI to blow up? And so you go up here and you're like, well, what if it was at 10%? What if it was at 15%? All right, at 13.5% or 14%, 14.75%, that's where it's going to blow up. So that's where this number becomes more than 70, and that's bad. So this is a really drawn out example of what I'm telling you is, don't get obsessed with chasing the bottom of the rate. Because let's say that you wanted to push this thing and you wanted to purchase a $1.7 million house in this example. So let's say this was actually 1.85 million and your DTI is already at 69%. And let's say that this becomes 6.35 or 6.75, then you've blown up. So like, don't chase the bottom, because interest rates tend to rise very quickly and fall very slowly. So like, you might say like, oh, well, I think I can get to 6.125 in the next couple weeks. And it's like, are you going to be more upset in this example that you're making or saving $150? Or, and more likely, are you going to be upset that it blew up your house and cost you $600? Because in order to make this happen, you're going to have to bring down, like bring cash to close to bring your rate down below. So you're now spending $100,000 that you didn't have to before because interest rates climbed faster than you could lock. So I hope that makes sense. If it doesn't, please feel free to ask any questions. This is the multifamily scenario example. So let's say you wanted to buy a $750,000 house and that payment, I'm going to make up these numbers, that payment was $5,000, right? So you're 25 on the front side and you think you could rent it for $4,000. So you want to see, can I afford 4-unit? I can. Sweet. And like, you don't even need a DTI exemption. You're good there because everything is making sense from like a 75% income basis. The other thing this calculator has is a down payment required. So in that example that we went through in the slide deck, $150,000 of entitlement, you're buying in San Diego. San Diego entitlement's 1149825, and you want to buy that $995,000 house that we just found. You're bringing $111,000 down to close on that house. So I'll send you this slide deck after. But there's lots of good stuff in there. The other things in there, like disability rating charts, like I always have to look at this stuff. It just helps do that. A property tax map. So these are like rough estimates from 2021, but it just helps you start to think about it like, well, what if I'm taking a job offer in California, Vice, I don't know, where's somewhere else? New Hampshire, where it's almost 2%. Like, which one should I go to? And so like you can play around with that. And then some case study resources. So nationwide property search, I would use Zillow. If you're going to New York City specifically, I would use StreetEasy because StreetEasy allows you to search between condos and co-ops. You can't buy a co-op with VA loan. You can buy a condo. The other thing is like, I would probably never buy a co-op because co-ops get to tell you when to buy or sell your place or rent it or any of that stuff. And then remember the numbers for DTI calculation are about 50%, below 50% front end and below 70% back end. Really, the 70% back end is slightly variable, but that's the number you need to worry about. And then greatest resource here, if I can do anything for you guys, please don't hesitate to call. If you have friends that are, missed this brief and have questions, I'm happy to speak to them about it. I will, if I don't text you back in 3 minutes, then that means I have gotten hit by a Mack truck. And that goes for probably like all hours until like 4 in the morning. So thanks for having me. It's been an absolute pleasure. And yeah, thanks guys.
Yeah, thanks, Will. I hope that when I'm ready to buy, you'll still be doing this.
I hope so too. Because I'm having a lot of fun doing it so far. But I can promise you that that even if I'm not doing, I'll still be a resource.
Thanks, Will. Pleasure listening in. Thanks for all the numbers and real life scenarios. Really, makes it realistic and maybe some of these things are actually achievable. I know $1 million sounds like a lot, but
Yeah.
if you have someone else paying it, it's not so bad.
Yeah. And like some of the numbers I blew up just to make them like stick in your head. Obviously my personal example was kind of crazy, right? Like I don't know if it was like my ego or what, but I was like, I need this big house. I don't live in that house anymore. I'm also not an investment banker anymore. I'm doing something that I think has purpose and I enjoy a lot more. But yeah, the numbers, it's a lot of numbers, so if you have any, questions along the way, just go back and look at the PDF deck and that'll kind of help you get through it. Well, cool guys. Well, Jarek, maybe I'll see you on the 6 p.m. If you guys want to go for round two. I'll be doing it here in another 4.5 hours. So see you then. Until then, enjoy LA and wherever you are in California or abroad, and hopefully I see you guys back there soon.